You hear about it all the time, right? On the news, in movies, the stock market. It can sound super complicated, maybe even a little intimidating, but it really doesn't have to be. So today we're going to pull back the curtain and break it all down nice and simple.
I mean, seriously, what is it? It feels like it's everywhere and nowhere at the same time. You just see these numbers flashing on a screen, these charts going up and down, but behind all that noise, there's actually a pretty simple and honestly a really powerful idea.
At its heart, the stock market is just that, a gigantic, organized marketplace. And you can forget those old-timey images of people shouting on a crowded floor. These days, it's pretty much all virtual. But in this market, you're not buying apples or oranges, you're buying tiny little pieces of companies.
Okay, so before we can really understand the whole marketplace, we gotta talk about what's actually being bought and sold. Let's start with the most basic building block of this entire system, the stock.
A stock is quite simply a tiny piece of ownership in a company. You'll hear people call it a share too, they mean the exact same thing. So when you buy a stock, you are buying your very own little sliver of that business.
And this is where it gets kind of cool. When you buy a share of, say, Apple or Microsoft, it's not just a number in an app. You literally own a tiny part of the whole operation. Their brand, their buildings, everything. And it makes sense, right? The more shares you buy, the bigger your slice of that corporate pie becomes.
All right, so we get what a stock is, but that brings up a really good question. Why would a huge, successful company want to sell off pieces of itself to a bunch of strangers? To answer that, let's flip the camera around and look at this from the company's point of view.
The number one reason is incredibly straightforward: to raise money. In the world of finance, they call this capital. See, selling stock is a way for a company to get a huge injection of cash, so they can grow, hire more people, build new factories, dream up new products, and they can do all of that without having to take on a mountain of debt from a bank.
Let's make this real. Picture a giant like Amazon wanting to build, 100 new warehouses. That's going to cost billions of dollars. Well, instead of getting a massive loan, they can just sell shares to people like you and me and raise all that money directly from investors.
And there's a special name for this big debut. When a private company decides to go public and offer its stock for sale for the very first time, it's called an initial public offering, or, as you've probably heard, an IPO. It is a huge deal for any business. So now we've got companies that want to sell shares, and we've got investors who want to buy them. So how do they find each other? This is where the market part of the stock market really comes into play.
This all happens on what are called stock exchanges. These are the official marketplaces that keep everything organized. Here in the US, the two most famous ones are the big iconic New York Stock Exchange, the NYSE, and the tech-focused NASDAQ. They're the central hubs where all this trading happens.
So how does your order to buy a stock actually go through? Well, it follows a pretty simple path. First, you decide, I want to buy 10 shares of this company. You place that order using a brokerage, think of them as your agent. That brokerage then zaps your order over to an exchange like the NYSE, which acts like a giant matchmaker and almost instantly finds someone who's selling those exact shares.
But what makes the price of that stock go up or down? Well, it all boils down to the oldest rule in economics: supply and demand. If a company announces some amazing new product and suddenly everyone wants to buy its stock, all that demand pushes the price up. On the flip side, if some bad news comes out and everyone tries to sell at once, that flood of supply drives the price right down.
We've covered the companies and the mechanics of the market. Now let's get back to the most important part, the investor. Why do people put their hard-earned money into all of this in the first place?
Well, the main goal is pretty clear. People buy stocks because they believe that company is going to be successful. They're betting that the business will grow, become more valuable over time, and that their little piece of ownership will become more valuable too.
So how does a stock becoming more valuable actually turn into money in your pocket? Well, there are two main ways this can happen. The first way is the one everybody knows: price appreciation. It's the classic buy low, sell high. If you buy a share for $10 and the company does well, pushing the price up to $15, you can sell it and pocket that $5 profit. It's as simple as that.
The second way is through something called dividends. You can think of these as a little thank you in cash. Some profitable, well-established companies will take a portion of their profits and pay it out directly to their shareholders. Not every company does this, though. A younger, fast-growing company might put all its profits back into the business to grow even faster.
So, when you put all these pieces together, what have we got? The whole point, the crucial takeaway is this.
The stock market is the engine that connects people with money to invest, with companies that need that money to grow and innovate. It's this incredible relationship that really fuels so much of our economy.
And that brings us to one final, really big idea. By letting pretty much anyone own a piece of the world's biggest companies, the stock market does something amazing. It lets us be more than just customers. It lets us be owners. It gives us a real stake in our shared economic future. And that leaves us with a pretty cool question to chew on. What does it really mean to own a piece of our economy?